Good morning, thank you for joining us here. I'm joined today by Jon Di-Stefano from Telford Homes, who, following the announcement of his interim results on the 29th of November, is here to give us a little bit more flavour. Thank you, Jon.
Not at all, Hannah.
Should we start by having a look at the outlook from your interims? And there's a lot of confidence stated there. Can you give us a little bit more flavour around that?
Yeah, I think the real message from our interim results is that although the numbers themselves are fairly flat year on year, the real story is in our confidence in our ability to deliver growth for the full year to March 2018. We've said that we're well on track to meet the market's expectations, and those are profit before tax of 44 million, which is nearly 30% growth on last year's 34 million. We've secured 95% of the gross profit in order to do that, and the other 5% isn't really that challenging, so we're very confident in getting to those numbers. We've also said that we're 65% secured in terms of gross profit to achieve over 50 million the following year. So we've got strong growth ahead of us over the next 2 years, very confident in delivering that, hence the confidence in the statement. And also, I suppose, there's a lack of supply of homes in London, and that's really what drives us to keep doing more and what really gives us the confidence in our future.
I mean, obviously lots of talk around housing in the last budget. Do you think the continued recognition from the government of the problem around the lack of housing in London is making things easier?
I'm not sure that it's necessarily making things easier. It's good, though, that both the government and particularly the GLA in London are kind of clear that we need to keep building more homes, because that clarity means that they won't do anything to make it more difficult. Whether they'll necessarily make it easier is probably open to some question, because it's quite challenging to get through the whole process that's needed to actually get planning and deliver things. But it gives us confidence, really, that everyone understands the problem. They're there to help. I think I'm more interested, really, less in the budget itself and the changes there, but in the London plan that came out last week from the mayor.
Yep.
And I think some of the things in that are supportive of what we're trying to do. I think it's good in terms of fixing proportions of affordable housing. That's a great thing. And also in terms of some of the discussion of build to rent that was in that document, are all quite encouraging for us as a business.
Okay, well, build to rent then. What percentage of that is the business now, and how do you see that changing over time?
Yeah, I mean, we've really got into build to rent in a big way over the last couple of years, and that's all. But because we've picked it up quite quickly, we've now got 4 different developments under construction, nearly 500 homes. So at the moment, it's 500 homes out of a total pipeline of 4,200. But we've been very clear that we think it really works for us. And to be absolutely clear, what that means is that we are taking a lower margin, but for a lot less risk and for money coming into the business immediately. We don't have to use any debt and hardly any equity to build out a build-to-rent scheme. They're all forward funded. And we really like that trade-off, and it's working for us. So we want to do more of it, and we think it's the right thing to be doing to meet what is an increasing demand from tenants in London to rent somewhere. So we want to do more. We expect to get to the point where maybe half of our pipeline is built to rent. We're still going to focus on individual sale. That's still an important part of the business. But we should be stepping it up over the next couple of years to increase the proportion of build to rent. The deal we did with Greystar just after our year end, which will be 900 homes, not yet in the pipeline, will be one way of doing that.
Okay. You've touched on Greystar there, and obviously you've got a very strong relationship as well with M&G. Are you nurturing other buyers as well to make sure you've got a good spread, or do you feel those are the 2 partners to take you forward?
Oh, I think that we'll see what happens in the future, but actually we've already done, in terms of the 4 deals we've done 2 with M&G, as you say. We've also done 1 with L&Q and 1 with Notting Hill. And also we're meeting probably new investors all the time. So lots of them out there. There's a lot of money coming into the sector, which is one of the reasons why we're so keen on it and why we're confident. I think we tick a lot of boxes for lots of partners, because not only can we find land in London, quite good at buying it, we hope, we also can get planning consents, and I think crucially we're the people who manage the build of all of our own schemes. We don't get a main contractor involved, so as an investor you're dealing with a one-stop shop, somebody who's doing the whole thing. So I expect us to attract other investors. And that said, it's obviously great to keep partnerships going as well. So I hope we'll get the best of all worlds by maybe doing a bit more with M&G, a bit more with Greystar, but maybe also introducing new partners as well.
Okay. Finding land then for these opportunities. What is the situation there? Are prices steady? Is availability easy, hard?
Well, there's still plenty of land in London. We only really develop brownfield schemes and quite complex sometimes, but there are still plenty of those opportunities out there. We are still seeing lots of them today, and we're quite close to a few now and in negotiations on a few now. Has the competition got any better or worse? I don't think so. There's still lots of people who want to develop in London, crucially at the right price point. So we really look to be on average price in our development pipeline at the moment of just under 540,000, and we don't want that to change very much because we feel that's the right average in order to meet the real need rather than getting higher up the price levels. So competition's still there. Prices haven't really changed that much because actually it's a function of sales prices and build costs, and both of those have been fairly sort of steady one way or the other, with just small increases on both sides at the most. So prices aren't changing. We think there is an opportunity out there to buy more, particularly for build to rent. We've recruited a new land and planning director in Jerome Gagan from L&Q, and he's very well respected in London development circles with a really strong contact book that I think will really help us, especially with a lot more public sector owned land coming out for sale, because there is that understanding, as we talked about already, from the government and the GLA that public sector land is needed to try and increase house building. So should put us in a good place to be able to continue to grow our pipeline.
Moving on then from land to build costs. There was actually a little bit in the papers today about the percentage of European workers who are sustaining building in London at the moment. I think it's around about 50%. How do you see that? Are you confident? Obviously Brexit's looming there on the horizon. Are you seeing an inflation in build costs?
Well, there's build costs definitely increasing, but only at a fairly steady rate. And in fact, we've seen perhaps not quite as much as we expected on some of our schemes. In terms of the EU labour force, I mean, it is important, and a lot of it's very skilled labour that we won't be able to find elsewhere in the UK. We're not overly concerned because I find it very difficult to believe that everybody will be sent home in some way, and that doesn't seem to be the current thought process either. But they do play an important part in London development, and I think without them we would have a real struggle. And the numbers that we're already struggling to achieve in terms of delivery of homes will just be pretty much decimated. It won't really necessarily be a price thing, it'll just be we simply can't build them because the people won't be there. But as I say, I don't think that's a significant concern unless we somehow start to play really hardball with everything in the Brexit negotiations, which I think we all hope won't happen.
Trying then to understand about the long-term structural changes around build to rent and the appetite from people to not own a home for a longer length of time. Do you think this is a more structural change, or do you think it's just based on current prices?
No, I think it's been changing over a long period of time actually. So the proportion of people that are privately renting in London has just increased all the time over the last 20, 30 years or so. I don't think that's going to reverse. So I think at the moment you've got a situation where yes, some people can't afford to buy, therefore they need to rent. They can't get a mortgage for various reasons. But equally now I think we're seeing an increasing trend of people who just don't want to buy, which is unusual in terms of the usual sort of need to own your own home. But it is happening particularly in London, where people maybe see themselves as a bit more temporary in certain locations, maybe have aspirations to go overseas for a while, whatever it may be. So there are a lot of people who just want to rent, and I think that's one of the reasons why institutional investors see residential property as a really strong place to put their money, because they know there's that rental demand out there, and that I don't think there's any chance of that turning around and all suddenly wanting to own their own home. And that'll be a change I think that just carries on. It's similar in some other countries as well, so it's not that we're unique in that happening.
Okay. Moving on from build to rent to the more traditional house building, we've seen a change in terms of the mortgage relief that UK buyers can achieve on their purchases in the buy-to-let market. Is that loss in demand being fulfilled by overseas investors, or is Help to Buy playing a role in filling that gap?
I think probably more so the latter, but obviously we have got lots of different customers now. So UK-based investors, overseas investors, owner-occupiers, and obviously institutions. So actually the main take-up from a lack of perhaps UK individual buyers has been really the institutions, and we've then been selling whole developments to one buyer rather than splitting it up to individual investors. That said, though, I think we're pretty confident that overseas investors are still active in the market for the right product in the right location. Don't really have, strangely, the same concerns as a UK investor over Brexit and the political landscape. Maybe they're not here day to day, they don't see the papers every day, so they don't really read about it, it's not right in their face. From a UK investor point of view, yes, far fewer of them now. There's been a sort of an ongoing onslaught really against buy-to-let, both from the point of view of reviews into the mortgage market and particularly tax changes, the extra stamp duty, and as you say, and particularly the phased removal of mortgage interest relief. So that's inevitably had an impact on the numbers of those. But we've also sold more homes to owner-occupiers, as you suggest, some of them through Help to Buy. I think probably it's more a sort of a coincidence in a way. The price point for Help to Buy is up to 600. Where it's there, I think people are bound to take advantage of it where they can. We have still sold under 600 without Help to Buy, and I think that's probably because that's the right sort of price point to be selling at, where people can afford it, whether they have help from their parents or whatever that may be. So we've taken the view that we're now selling quite a bit really upfront to institutions. We'll sell a few to individuals from an investment point of view, perhaps mainly overseas, and making the point, of course, that overseas investors very definitely look for a tenant and rent them out. They don't sit on empty properties, certainly in the sort of homes that we're developing.
Yep.
And then really leaving some to the end for owner-occupiers. So we've got a couple of launches first quarter of next year. One of those, New Garden Quarter in Stratford, will be for individual investors. And we'd expect that to do very well. It's a good price point, just under 550,000. And in Stratford, where we've sold very well before. And then Bow Garden Square, which is in Bow, which the average price is under 500,000. And we'd expect that to be very much an owner-occupier product. We're within 6 months of completion. I'm sure quite a few people will take advantage of Help to Buy. There'll also be a stamp duty saving on quite a few of them as a result of the last budget. So I think that market's very definitely there too, despite us talking about tenants, how important they are. So I still think we're doing quite well in terms of getting a good spread of different customers to work with in the future.
Are you expecting to see a strong beneficial tailwind from the stamp duty? I mean, it's what, £5,000?
Not really.
No.
So I think it's a nice thing for a first-time buyer to have, and maybe it'll benefit them particularly where they're buying a second home property, where they obviously wouldn't necessarily get their stamp duty paid by the vendor or anything like that. Some developers pay stamp duty anyway. Whether it'll create extra demand, I'm not too sure, but I'm sure it'll help some first-time buyers to get over the line in terms of making a purchase. So I think that'll be beneficial, but I wouldn't say it's not really a game-changing thing from our point of view.
No. And are you planning on taking New Garden Quarter over to Singapore, China?
Yes, we will, but Hong Kong and China really are the locations where we've seen highest demand and where we will go. We will obviously launch it in the UK first, but we've talked about there might not be quite a strong demand there. And there is still a lot of interest in London despite all of those uncertainties overseas. So we'd expect to have some success over there.
Okay. Let's loop back to your development pipeline, which we touched on earlier. At the moment, you're at 4,200 homes.
Yeah. I mean, I think so. At the moment, 4,200 homes worth 1.4 billion, and it's got quite a nice spread in terms of how it plays out over the next few years. We've got a little bit that's much longer term. that came from our acquisition of United House a couple of years ago. But if you look at how it spreads out over the next 5 years, we've still got nearly 200 million of revenue in the pipeline for 2022, so 5 years away essentially, which is a good place to be. And everything we buy from here should therefore increase the revenue each year and sort of make sure that we're growing over time. Where do we expect it to get to? It really depends on the opportunities we find at any one point in time. I mean, the Greystar deal, when we move beyond the pre-construction agreement to a full build contract, kind of immediately adds 900 homes to the pipeline straight off. So we've set ourselves up operationally so that we can do far more than that. We've made a few operational changes in the last few months. That will enable us to, technically speaking, have a pipeline of anywhere up to 10,000 homes. Now, that doesn't mean that's going to happen in any short order at all, but no reason why we can't increase that and maybe even double it over the next 4 or 5 years. So we're there to build more homes because we know more homes are needed.
Well, doubling your pipeline sounds like a good, strong ambition for the next 5 years, Jon. Should we see a change in government to a Corbyn-led government, how do you think that will impact the business?
Well, I suppose it's difficult to say until you know exactly what the policies would be. Obviously, some of them have been trailed, but I think the most important thing is that all parties recognise there aren't enough homes being built. So we're there to build homes. We've got a skill set in doing that. So we shouldn't be too nervous about another government coming in that wants to build more homes. They're not going to find the skill set somewhere else to do that. So we are the people who should be trying to do that with them one way or the other. Yes, there have been some concerning things involving rent controls and things like that, which I think would really damage the rental market in London. I'm sure it would, and certainly damage the institutional demand. Therefore, to some extent, I wonder whether those will come to fruition in reality should they come into power, because I think that they will realise that they want to deliver more homes, and that anything that restricts that is not a good thing. But we are there to deliver more affordable housing. We like working with housing associations. We like the fact that Sadiq Khan has started to look at fixed proportions and making sure people don't try and get away with delivering too little. So I think actually we meet quite a lot of the things the Labour Party's trying to achieve. The detail of the policy will be important, yes, but I don't see any reason why we should be too frightened, given that we both want the same thing at the end of the day, which is to keep building more.
Hi, Katie.
Hi.
Moving on then to the financials, can you give us an overview of the half-year results and the main points you'd like to pull out?
Yeah, so although overall PBT pretty flat half year to half year, what we're really happy with is that we're on track for the full year profit before tax, our forecast and the market expectations. So we've said over 40 million and the market forecast expectations is around about 44 million, and we're well on track to do that. The majority of our revenues and profits come from the open market completions in a period, and in this financial year they're more weighted towards the second half, which is exactly the same as it was in the previous financial year. So on track, and everything happened as was expected to in the first half, and the completions have continued since the 30th of September as well to deliver the full year profit figures. Really pleased to see an improvement in the gross margin, and equally we've said that we expect to improve our operating margin across the full year as well compared to the operating margin in the previous year. So really we're ignoring the weighting half year to half year, and we're concentrating on the full year results. And to prove that we're on track and confident in the full year results, we're paying an increased interim dividend of 8 pence per share. And the market expectations for the full year is around about 17 pence. So we're paying almost half of the full year, even though the profit split doesn't fall in that way.
Okay. Moving on then to gearing. Obviously analysts are suggesting it's going to increase in the short term, but it sounds like build to rent should assist in bringing it back down over the long term.
Yeah, so we do use debt within the business. We're a relatively small business and we're a growing business. And although we're doing more build to rent work now and I expect that to increase in the future, there's still a lot of units underway which we've sold on to individuals. that need to be funded through a combination of debt and equity. So at the minute we've got almost 2,500 units under construction, a lot of them pre-sold, which is why we're not afraid to use debt within the business. So gearing is expected to increase over the next 6 months, and the broker forecasts are suggesting that. However, we've got the pre-sales within the business to cover the debt. Longer term, we do expect then build to rent to become a bigger part of the business, and as it doesn't require any debt or equity, our overall debt requirements then reducing and our gearing levels falling back down.
Okay. We're looking obviously at growing profits over the next few years. Is that going to generate lots of additional cash that you're then going to pay out to shareholders?
Yeah, well, obviously we're selling a lot of homes, we're doing more build to rent work where we get cash back into the business. However, we want to grow the output, we want to increase the number of units we're delivering, both build to rent and open market, and therefore we'll be reinvesting the cash coming back into the business from pre-sales back into new sites and work in progress. So cash will come in, but obviously cash back out as well. Delivering on the profit forecast, we're increasing profits thereafter because of the reinvestment. And we're also, as we've just said, paying out a dividend as well, so paying out a good dividend. A third of our earnings will be paid out as a dividend, with the remainder reinvested into new sites.
Well, Jon, as you said, you're firmly on track to deliver a PBT of 44 million for the year end. How would you summarise the outlook for the business?
Yeah, I think so. We're very positive, as we said, about the numbers side of things for both this coming March and the following March. I also think that with our increasing move into build to rent, we've got a good risk profile in the business. The balance of risk is pretty good. We've got the capacity to do more, and I think the market opportunity is there to do more. London needs more homes, and they need more homes at the price point that we're delivering them. So there's a great opportunity for us to get out there and even further that growth from where it is now. There is some short-term uncertainty out there at the moment around the EU negotiations, the political landscape and things like that. But I think they're far more outweighed by the long-term fundamentals of needing to get more built and needing more homes. And that's what really gives us the confidence to deliver on our aspirations and keep growing Telford Homes.
Thank you very much for joining us today.
Thanks very much, Hannah.